Yep.
Yes.
Okay, good, because I am like moving between the PowerPoint and my script. I don't want people to see the script.
Okay. Okay. It told me connection has timed out. Please try again. So I am going to try again. Okay, I think it's going live. For real.
Okay.
Yeah, so I just noticed that everyone muted themselves. Someone just give me the green light when I can begin, and I'm actually ready to begin. If that is the case. Ooh.
Yeah, we're live now.
All right, so will I begin?
Yep.
All right, so hi everyone. Thank you for joining me. This is going to be my lecture on finance. Particularly, it'll be about finance in the Philippines. So as I'll explain later, there'll be a number of topics that could be considered under finance that I won't be covering. But fret not, for if you would like to ask me questions about those topics, I'll try my best to answer during the Q&A session that I'll be holding at the end of this presentation. But before we proceed any further, there's just a bit of introductions that I want to do. It will be twofold. So two things just to begin. Firstly, who am I? To the viewers who are unaware of the nature of the link that they have just clicked on and are tuning into the stream, I'd like to introduce myself and what they're about to tune into. And then secondly, for everyone else, I'll try to narrow down the context of which this lecture would cover, just so we have a more nuanced, how do I put this? Where you guys are more prepared to engage in the discussions that I'm about to begin. So just to introduce myself very quickly. So my name is Nicolas. I'm from the Ateneo Debate Society. I graduated from management engineering as my major. I interned in Union Bank and in Deloitte. I mentioned these things just to lead to my first disclaimer, which is while I will be discussing things like microfinance, financial inclusion, shadow banking, and other financial services that are provided by the financial sector currently, I have so I'm not offering any like real professional advice. Rather, I'm just leveraging personal experience that I've gathered from both debate and my internship and school experience to provide you unique insights I've gathered and ways in which these insights can be applied throughout debate. Uh, Secondly, then, what is the scope of this lecture? So I want to talk about this disclaimer a bit more than the first. Finance as a topic covers many broad issues, especially in debate, and a result of that is that finance has become loosely used whenever motion setters try to indicate that their theme is finance. And that's fine because in its most rudimentary form, finance really is just about the study of how funds and money is used. And when when stripped down to its rudimentary form, really finance covers a lot of different things because money is used by governments, it's used by international bodies, it's used by individuals, it's used by banks, it's used by non-government organizations. And really any debate that covers how any of these entities would choose to use their cash, their money, their transactions, their reserves would be considered finance to an extent. With that being said, what then will I be covering mostly throughout this lecture? I will mostly be covering the use of finance in the context of the individual, the banks, and businesses. So it's more of the micro context. That is to say, I'll be elaborating on the context of which in the Philippines and our citizens and our banks, what exactly is currently relevant in terms of finance in these particular sectors of society. There are two reasons why I'm doing this. Firstly, I just personally feel more comfortable talking about this part of finance than any other part of finance because it aligns more with my own personal experience. Those personal experiences being, for example, like in Union Bank, where I worked in their fintech firm, UBX, and worked mostly on improving microfinance innovation. And also because of my own personal interest in things like microfinance. The second reason that I am doing this or focusing into this context in particular is because my observation at least is whenever we engage or in the vast majority of debates about finance in the Philippines, teams tend to homogenize what the financial position is of the vulnerable sectors and businesses in the Philippines are. For example, they make sweeping claims like private banks are not fulfilling their jobs, that people don't have money and are poor. And while all of these things are correct, and while it is true that our financial sector is problematic in different ways, it would be far more compelling if debaters and adjudicators were more familiar with the particular nuances that are currently afflicting our country, and rather than relying on sweeping allegations against our financial sector. So that is the thing I want to accomplish, where teams are less likely then to homogenize the financial position of our country and will instead be able to use the nuances I will introduce throughout this lecture. So that's the disclaimers. Let's now proceed to the lecture itself. The most prevalent trend that can be observed in the Philippines in terms of its financial position is that we have a very low level of financial inclusion. Let's first answer the question before I talk about these three things. What exactly do I mean by financial inclusion? Financial inclusion refers to the level of which people within a state have access to different financial services and instruments. These services include savings, credit, payments, and insurance, to name a few. Moreover, access does not only mean, in this context at least, availability of these services, but the capacity of which an individual has access to a good quality amount of these services. That is to say, it's this access, or the access we are measuring here, is only greater when these services are of high quality, actually improve the lives of its users, are utilized consistently, and are not maliciously designed to manipulate the behavior of its users for perverse incentives of its makers. More on the latter in the issue about shadow banking. The three buckets you currently see are the primary three reasons why many analysts, both within the Philippines and outside, suggest that the Philippines has a very low level of financial inclusion. So the first one is due to the large unbanked sector in the Philippines. According to data collected in 2019, so this was right before the pandemic, by the Bangko Sentral of ng Pilipinas, 71.4% of the adult population in the Philippines do not have access to banking services. If the percentage is not visceral enough, visceral is the wrong word, it's not illustrative enough, that there are 51 million people in the Philippines who currently don't have access to banking services. The primary reason why this is the case is simply because most of the Filipino population are not able to meet traditional banking requirements. For example, most of the traditional banking services that are currently being provided require a lot of documentation before you can get an account. This documentation includes things like valid IDs, passports, as well as other forms of proof of identity prior to you being given an account. The problem is that most of these documents are actually very difficult to acquire for many vulnerable sectors, especially when they're, for example, not born in hospitals or were never granted passports by their local government units. So even if, for example, they have sustainable livelihoods and are doing well for themselves, because of their context, many people don't have the documentation necessary to form bank accounts at the end of the day. In addition to this, many individuals as well don't score highly on the traditional bank's credit rating scores. Whether or not this is because of their income class or their educational background, many private and traditional banks are reluctant to provide these individual services or provide many vulnerable sectors in the Philippines their financial services, because to them, these are risky clients. They don't want to pay for the risk of granting these people services, because the point which, for example, they default on their loans or they're unable to pay. They default on their loans or they withdraw all their money from the banks after they make accounts. These are harmful to the banks, and they don't want this to happen on a wide scale. The implication here is that even most people who have bank accounts, so the first thing I mentioned earlier was to prove that many people don't even have accounts at all. The second thing here shows that even if you do have an account, it's not an assurance that the quality of services you're being provided are of high quality. So these are the structural reasons why we have a large unbanked sector in the Philippines, which leads to a very low level of financial inclusion. What are the primary harms then from being unbanked? So there are two. The first is that most of your money is unsecured. This literally means at this point in time, this means you, for example, I'm trying to think of the optimal way of putting it into words. Now I have it. This means that your life savings, for example, rather than depositing it in an account or in an ATM, a lot of these people keep it in boxes in their homes. And this might not sound as bad as it is when you just think about, oh, then I just need to find a safe place to put it in your home, and then your life savings, quote unquote, are fine. But when you consider, for example, that the Philippines is in the Pacific Ring of Fire and is constantly subject to things like earthquakes, landslides, natural disasters like floods, it's actually incredibly risky to keep all of your money with you on your person. Because, for example, the vast majority of individuals who live in provinces who are susceptible to these kinds of natural disasters, when their homes are submerged underwater or buried underground because of a landslide or ravaged because of a thunderstorm, all their money, or at least it's a very high probability that their money won't survive these disasters, much like their home, which means the point in which they are unable to securely keep this money in a bank, at any given point in time, all their life savings could go away. Imagine the risk or the vulnerability of someone whose college fund, which is, for example, let's say you're a parent and you're saving up for the college fund of your children. You're probably doing this as early as when they're infants. You need to continuously save for the next 15 years of your life. And then your only hope is that in the next 15 years, no natural disaster is so strong that it buries your home. Because the moment that it does, all your savings are now gone. That is the most prevalent risk of going unbanked. Your money is unsecure. And this isn't to even cover all the other ways in which your money can be compromised outside of natural disasters. You keeping your money in your home means you are responsible for securing your money. That is to say, anyone can break into your home. It's much easier for people to break into your home than to break into the bank, for example. Another could be interest, where if the value of the peso suddenly increases, your money does not benefit from that if you keep it at home, where it does not increase with the interest rates that banks normally offer its clients when they deposit money in the bank. So that's like the first bucket of harms that apply to people who are unbanked. The synthesis of it being, because they have to keep it on their person, there are many consequences, whether or not it's to security or to its value. And the risks to security come from natural disasters, other people. The risks to its value come from inflation that you can't control as an individual. That's the first primary harm of being unbanked. The second primary harm of being unbanked is you are withheld many opportunities. The fact of the matter is, and I think this is more relevant now than any other time, is that the vast majority of transactions nowadays are cashless. That's because almost everything is online. The e-commerce industry has become probably larger than the traditional commerce industry, or at least forecasted to be larger than the traditional commerce industry at this point in time. The big implication being, if someone is looking to flourish in the current trends of the economy today, it will be incredibly difficult to do so if you don't have access to online banking. Online banking is typically something you can only access when you have things like a credit card or an e-wallet, or things that, if you are unbanked, are incredibly difficult to get. Because even the most rudimentary GCash account, for example, requires a SIM. And at that point, even Globe themselves would be reluctant to give SIMs to anyone just like asking for SIMs, for example. Right? Normally, the plans that give the most good data plans require payment through installments. And that is very difficult to do without a bank account. So even at this point, so even if you are completely free from natural disasters, even if the value of your money will never be compromised because you're in a perfectly stable economy, it's still a huge risk to you to go unbanked, because you not being able to leverage online financial services provided by most banks means you are withheld a lot of opportunities that are prevalent now because of the strong transition to the e-commerce industry that we are currently facing because of the pandemic. That is the first real big harm that comes from, or that's the first primary reason why there's low levels of financial inclusion in the Philippines, and some of its very prevalent harms. The second big reason why there are low levels of financial inclusion in the Philippines is because we have low levels of financial literacy as well. Similarly, allow me to define what I mean by financial literacy in this context. Or allow me to first actually explain the importance of financial literacy. Because even if you don't believe everything I just talked about earlier about there being a large unbanked sector in the Philippines, and you don't believe what I talked about earlier, where I talked about there being poor financial infrastructure in the Philippines, even if the Philippines had access to good quality financial services, this is not tantamount to there being deep engagement between the users and their service providers. For example, in an instance where an individual is unable to optimally and appropriately navigate even the most ideal financial industry, it is incredibly likely that they will just waste the opportunities that are presented to them. For example, or for another more specific example, even if you had the best fund manager in the world, provided to you by the best bank and insurance company in the world, trained to meet your specific needs at that point in time, a client would still have the foremost say in the use of their funds. And if the client is not able to make the most appropriate decisions at that point in time because they weren't properly informed about how they could optimally use their money, they can overrule their fund manager and waste their money in these instances. The implication being that the issue of financial inclusion isn't just structural, it's also educational to an extent. It's informative to an extent. We also need to work on being able to improve the awareness and information distribution surrounding financial instruments and their use. So that's one of the most important things. The problem then is, with all of these things in mind, it was actually concluded in a study by the BSP in 2018 that a majority of Filipinos lacked sufficient information and knowledge to make informed financial decisions. The implication again being that should someone, or if ever there is a debate in the future about where we're best able to improve the financial position that most individuals currently find themselves in, it's not enough for a team to go, we will be strongly improving the infrastructure provided to the civilians of the world or to the citizens of the Philippines. It's also crucial that they are able to prove that they improve the way in which information is distributed to their citizens. Because again, for these reasons, it's not enough to have good infrastructure. This infrastructure must be used well by the people that they are targeting. The third reason why financial inclusion is incredibly low in the Philippines is because of the I did not know there were animations there. My mistake. Where the high levels of income inequality. Even if we rectify, so the point of this is to say, even if we rectify a lot of the harms that were created because of the structure of the financial industry, even if we rectified a lot of the information problems that we currently face, as the old adage goes, if we let all the wealth settle with just a few people, what they're going to do is disproportionately use this cash to leverage their favor. That's because the old adage further goes as the rich having an easier time making money, because what they do is they use the money they already have to access even better financing options than those who don't have the privilege of being able to leverage, of being able to, how do I put this? Not burden themselves with the risk of losing a significant portion of their own money. For example, if you are someone who has a lot of assets, this means you can afford even burdensome constraints, even burdensome collateral constraints, for example, which means you can access low interest loans better than other individuals. Moreover, you can purchase things like treasury bonds as investments, which means you have access to more secure forms of investment as opposed to other individuals. That being, if only a few people can access these opportunities, it is abhorrent, which is why it's problematic that, for example, there are large levels of income inequality in the Philippines. I'm sure most of you already knew this from the very beginning. Allow me to put it into a few numbers for context. In 2014, the savings gap was at 40%. That is to say, when you get like the top 1% and all the savings of all the people who are not in the top 1%, the propensity of which an individual is able to save is 40% different than those of the top 1%. I'm not sure if it's able to capture the definition of the term correctly. The point being that the capacity of which an individual is able to save their money is much lower if you're part of the vulnerable sector as opposed to if you were not in the vulnerable sector. That is to say, even if you put everything into proportion, the propensity of which those in the vulnerable sector can save is lower. Moreover, in 2020, in 2020, it was shown in a study by Business Mirror that not only is our poverty incidence growing, but also they're forecasted to worsen in the incoming years. The implication here is that there is a disproportionate advantage being given to some of the elite in status quo, and that they're able to not necessarily weaponize, but capitalize on this advantage to leverage the financial sector for their own benefit, as opposed to the benefit of those who are currently being unbanked, for the reasons I mentioned earlier. That is the most prevalent trend that's currently happening in the Philippines surrounding its financial industry. I'll recap before I proceed to the second, that because of, so just like, I'll go back to the beginning just so I can summarize or make the summary easier. Because of a large unbanked sector, many people are deprived of opportunities. The few who are not deprived of opportunities are unable to capitalize on these opportunities because of the low financial literacy levels as well, thus leaving many individuals in a very woeful state. And on top of these two harms, because of high income inequality, the elite are then able to capitalize on, furthermore, their privilege to further benefit or to further intensify the amount of profit they make from the financial sector, while many other individuals continue, to be in a position of which they are unable to arrive at the financial security they need to live a normal life. That is the summary of the first most prevalent trend. In response to this, what happened was, in many recent years, a second booming trend manifested itself. This being microfinance and financial technology. I won't be talking about financial technology very much. Just note that the most common form of microfinance, or the most common way in which microfinance manifests itself, is through financial technology. Financial technology is the use of financial instruments in the digital landscape. So things like GCash is an example of financial technology. ATMs actually would be considered an example of financial technology. It refers to make it simple, financial technology is just the movement of leveraging technology to improve the financial services the financial industry provides. So let's talk about microfinance then a bit more. Just give me one moment. Okay, here we go. So microfinance, for people who are unfamiliar with what it means, microfinance is the subsector of financial services uniquely designed to target small businesses and the poor. Microfinance organizations provide, so simply put, they're the same as banks. They give you ATM accounts. They loan money to you. They allow you to purchase, in some instances, funds. But the difference being that they make a few differences to their business model, such that they're better able to cater to the needs of the poor and the vulnerable. And they do this in two ways. Firstly, in the vast majority of instances, they have fewer requirements prior to providing its users with their services. These fewer requirements include, but not limited to, not requiring documentation before giving you an account. So what they do is they let you go into the bank. They just ask you for your name. Sometimes they ask you for just one ID instead of 2 or 3, which is the norm for most other traditional banks. Or if not this, they also sometimes don't ask for collateral anymore. More often than not, if you have a large loan in the bank, they ask you for collateral, and this collateral can be your house, it can be another business you own. In the vast majority of instances, microfinancing organizations won't do this anymore. In addition to this, they also have lower credit score thresholds. So this is not the exact example, but let's say if I were a traditional bank, I would not lend money to anyone with a credit score rating of B or lower. It's more likely than that a microfinance organization would even lend to a CCC or something along those lines. The second way of which a microfinance organization is better able to cater to vulnerable sectors and the poor is they're actually able to hedge risk by giving loans to many people at once. So I want to use an example of this because it's a bit hard to describe with just definitions. So when a bank lends money to someone, that risk is expensive. The risk is expensive, especially if the loans are very large. That means that in the vast majority of instances, a bank would not lend you a loan unless they're convinced that this risk is something that is worth their cash, or something that is unlikely to become the worst case scenario if you're defaulting on your loan. What they do then in microfinance organizations is it's hard for them to, or the impacts of risk are actually greater in microfinance organizations because the interest rates they charge are higher. That's because this is the only way they can account for that risk, because they have to give a higher interest rate because these people are riskier clients, it's more costly. The loans are more costly, and that's normally the trade-off that they encounter. What they do then in this instance is they're actually willing to lend singular loans to multiple people so that the risk is more diversified. Because in theory, it's less likely that 10 people all at once will default on their loan as opposed to just one person. Moreover, if one person in the group of 10 default on their loan, the impact then of the default is much lower as opposed to one person defaulting on their loan. Because when one person defaults on their loan, it's the entire loan that has just been defaulted, which is harmful to the bank. So that's another way of which the microfinance organizations are able to reach out to the poor. So I want to talk about this a bit more. I'm just opening my, okay. In addition to microfinance becoming more prominent, it's actually been strongly supported by the government. Its origins go as far back as 1997, where I forgot the exact name of the project then, but in 1997, there was a strong movement to reduce income inequality. And one of the particular objectives that was identified by the government then was the introduction of microcredit. However, moving away from 1997, the impacts actually of microfinance were most profound in 2015, when the National Strategy for Financial Inclusion was introduced to encourage micro savings from citizens. What they did was they established many microbanking offices and NGOs in provincial regions. And in addition to this, it also led to the formation of the Microfinance Council. You can look them up online. They're basically an organization that seeks to promote the proliferation of microfinance organizations and services. They are composed by over 24 private banks and nonprofit, non-government organizations. The implication here simply being microfinance wasn't just something that emerged. The government and the private sector both have been working together to help this emergence as early as 1997. The most profound benefit of microfinance and why it's a very popular topic in not just the Philippines, but many developing countries, is its ability to increase access to financial services, and particularly minorities. Because a vast majority of these individuals or banks would not be willing to loan or provide services to these individuals. Now that a organization exists in which they don't require documentation or as much stringent documentation, or they don't require a stringent collateral, it increases the amount of competition that banks face, and it also encourages even traditional banks to start improving their services. So what are the benefits that can be stemmed from this premise? Number one, the microfinance organizations themselves provide access to a lot of services that would have otherwise been withheld from many individuals because they don't have documentation, they can't meet the collateral constraints, and all the other things traditional banks would ask. In addition to microfinance banks providing these services, there's now higher propensity or now a stronger movement from traditional banks to start improving their services, because if they don't, many individuals will no longer opt into their services and instead opt into the microfinance sector. But in addition to these profound benefits, there's also, on the other hand, very profound harms in microfinance. That being something I alluded to earlier, there's actually a lot more risk, because the most common use of a microfinance organization isn't just making in a bank account, it's also funding businesses. And many, obviously, a lot of people want to make businesses because it's a very easy way to make money, but it's also a very risky way to make money. And a lot of people argue that the interest rates that microfinance organizations charge their users are higher than the rate of which they make money with their businesses. And what this does is it leads to many businesses defaulting on their microfinance loans. So there's several implications here. The first implication here, if you want to, in the future in the debate, compare microfinance from a traditional bank, is that because a microfinance bank has to offer a higher interest rate, there's a higher likelihood that the clients of a microfinance bank would default on their loan. Even if it's not the higher interest rate, it's the lower credit score. Now that we know that there's a higher likelihood that the loan would default in a microfinance organization, the next premise becomes a bit more relevant, which is a default in a microfinance organization is more impactful, relatively speaking, when compared to a default in a traditional bank. So this is where it gets very debatable, because most microfinance organizations spread out their risk. So it'll be one loan, but the one loan is actually hedged between 10 different people. If 10 if one person in this 10 group again defaults, the impact is low. But imagine a world where all 10 of them default, which is not out of question if you believe the first part of this discussion, which was the propensity of which these people would default is greater than usual. In the instance where all of these people default on their loan at once, because microfinance banks typically don't ask for collateral, it's so much harder for them to recover from these defaults as opposed to traditional banks who can just use the collateral to finance their other services. In instances where these microfinance banks don't have their collateral, they will have a significantly harder time providing services to their other users, even if these other users are not doing anything problematic with their money. So this is why actually microfinance is very debatable right now. It answers, or how do I put this? Okay, I got it. While it seeks to solve some of the most prevalent problems that poverty and discrimination have begotten, it creates many new problems that are also disruptive to the financial industry. For example, while it seeks to solve the very prevalent problem of financial inclusion, the very prevalent problem of a large unbanked sector affecting almost 2/3 of the Philippines, it creates new problems like very risky loans. It creates new problems like loans that don't have collateral. These are things that people need to start comparing against each other. Is the potential benefit of reducing the unbanked sector greater than the risk of people defaulting on their loans and these defaults having larger impacts than normal? With that being said, I would say the fairest way to then look at the situation is to leverage context instead. Is the risk of being unbanked, like I mentioned earlier, greater than the risk of taking high interest loans? Is the potential of government institutions supporting microfinance greater than the potential of our economic security improving? Do structural solutions cover pervasive income inequality and financial illiteracy? Because after all, opposition in some microfinance motions could argue that we would rather, instead of government supporting microfinance organizations with the NGOs and other projects I mentioned earlier, this capital should have been spent either improving traditional banks or providing more job security. These are things that could be heavily debated upon. And admittedly, I don't have an answer because it's really contextual. It's really difficult as well to assess, because one of the strongest arguments again in favor of microfinance is it's incredibly difficult to navigate online e-commerce without it, so on and so forth. If I talk about all of it, I'll go in circles. I'll let that be homework to the viewers. I think it's up. I've given you the information. It's up to you to decide if microfinance is either the solution to our problems and worth the risk, or something we are better off without. That's the end of microfinance, which is the second most prevalent trend, or the second most prevalent issue in terms of finance in the Philippines. This is the third. It's shadow banking. But shadow banking, admittedly, is not as prevalent as the low levels of financial inclusion and microfinance problems that we are encountering today. So there are three things I want to talk about in relation with shadow banking. I'll just first quickly define what shadow banking is, talk about its competitive advantage over other financial instruments, but also talk about the risk it introduces. So while not as prevalent, shadow banking systems refer to all financial intermediaries and services that are provided to individuals outside of banking regulations. So the implication here actually is that microfinance is still regulated. However, even if it is regulated, the government is well aware that there's higher risk involved in microfinance transactions, but they're just letting it happen. On the other hand, shadow banking transactions are things that the government are not aware of and are incredibly risky in the vast majority of instances. The way to look actually at the shadow banking industry is to look at it as the equivalent of the informal economy, except for the financial industry. So these are still organizations. They're not necessarily they're not always predatory sharks. So loan sharks are considered shadow banking, but similarly to how not all black market transactions are drugs, not all shadow banking services are just loan sharks. There are actually some reputable organizations that I don't know the names of, but are out there that do provide their financial services to users outside of the bank's regulations. And it's still also debatable whether or not these are things we would want to allow. But in the vast majority of developed countries, they are downright banned. Allow me to explain a bit more then to elaborate on why that is the context. So let's talk about the first. What exactly is the advantage that the shadow banking industry has over microfinance and other traditional banks? It's their freedom from restrictions imposed onto them by the state. For example, they don't need to comply with recommended liquidity ratios. Liquidity ratios referring to how much of their cash is their own when compared to the amount of cash that they borrow from their clients. So most of the time, banks have a limitation there. They need to have an amount of money that is actually theirs, an amount of money that is borrowed from their clients. This is because if all the money that is borrowed from the clients disappears, they want the banks to have enough capital to provide financial services. Some shadow banking institutions are not, or actually no, shadow banking institutions are not subject to these kinds of limitations. They also aren't affected by limitations in terms of the kinds of services they provide. I'll talk about the latter more. The benefit here is they can provide, in some instances, low interest rates for large loans. The reason why you don't actually hear this very often is because there's a misconception about the shadow banking industry. People just, as I mentioned earlier, people just make the homogenization that everyone in the shadow banking industry wants to exploit its users. And while admittedly, there are organizations that will do that, not all organizations would do this. In fact, it's in the shadow banking industry that you can find the lowest interest rates in the financial sector. But that is because there are a lot of trade-offs that are involved. These banks skip a lot of regulations that are supposedly put into place to make sure that your financial transactions are safe. And I'll be elaborating about that now. So the biggest criticism towards shadow banking isn't just that they have volatile interest rates, because some of them are really low, some of them are really high, if it comes from a predatory bank. The other is they actually hedge different forms of problematic security. The most common being derivative security. So for people who aren't aware, I will explain why derivative security is bad. And this is really just an explanation as to what caused the housing bubble crisis back in the United States. What some banks do in the shadow banking industry is, after they loan someone money. So let's say I'll use an example. I'll be using some names of the people here in the Zoom call just so it's easier for me. Let's say I'm a bank. I am a bank that is a member of the shadow banking industry, and I'm loaning money to Jillian. What I'll do let's use simple numbers. Let's say Jillian wants to borrow 1,000 pesos from me. I say, okay, when I taking into account interest, Jillian has to pay me back 1,200 pesos. So that's the loan. I give Jillian 1,000 pesos. She owes me 1,200 pesos. Suddenly, in the middle of this loan, I go, I don't want to wait for Jillian to pay me back anymore. I need that profit now. What I do is I sell this loan to JM. I tell JM, Jillian will pay me back 1,200 in a month, but I want money now. So if you pay me 1,100 now, I will sell to you Jillian's loan, and Jillian will pay you the 1,200 that she owes me. So that's a kind of transaction that banks in the shadow banking industry partake in, and that is called hedging derivative security. It's a very rudimentary example, but I hope it gets the idea across. I initially loaned 1,000 pesos to Jillian. She owes me 1,200. But because I no longer want to wait for Jillian to pay me back this money, I instead sell the loan at a profit to JM, who buys the loan from me for 1,100. I make 100 pesos. And then if Jillian pays back her loan, Jillian pays JM 1,200, JM makes 100 pesos. The issue here is it creates a perverse incentive for me, the bank, to give as many loans to as many people as I can. Because I am no longer interested in making loans that are safe, because I don't care about the risk. I'm going to be selling this loan anyway. I'll just be making as many loans as possible. So I can sell a loan to Jillian, I can sell a loan to Romano, I can sell a loan to JM. I don't care if, for example, Jillian has the lowest credit score rating in the world, or JM has the lowest credit score rating in the world, because I know I will be selling this loan to someone else in the future, no, I won't stop myself from making this loan happen. The issue then being, if all of these people start defaulting on their loans, all the people that I sold these loans to lose all their money. Well, they don't lose all their money. The money that they spent on this loan is effectively wasted. And if this happens on a mass scale, all the people who participate in these loans, it's like lose all their money. It's a lot of money that is lost, and it's harmful to the economy when people lose their money on nothing. So that is a very rudimentary example. I'm not sure, like I'm pretty sure a lot of people might want to correct me there actually. Feel free to correct me. I'm not sure if I was able to get the examples on point, but I think the principle of that discussion was sufficient. That is to say, there are some practices in the financial sector that are problematic for the reasons I mentioned earlier. They manipulate the behavior of people for not their benefit, but for the benefit of the financial institution. It benefits me as the bank to give bad loans because I know I'm going to be selling these bad loans to people who will be losing their money. And these instruments have since been made illegal in the traditional banking sector. They have not been made illegal in the shadow banking sector who participate in financial services where they are not regulated. And that's a very strong criticism against shadow banking. The synthesis here being, and this is something that you can, assuming there was a debate about microfinance, right? You could actually talk about how it's good that we have microfinance organizations because we don't let people then fall into the shadow banking sector. The shadow banking sector can be problematic for the reasons I mentioned earlier. Some of the instruments are uniquely problematic to the people who partake in them, even if the institution itself is well intended. And so, even if microfinance itself is not the best or the most ideal subsector of the financial industry, it could be a comparable alternative to other financial instruments that are currently available out there. Oop. Yeah, and that's actually it. So these are the three most prevalent things about the financial industry in the Philippines today. I'll just quickly synthesize it before I proceed to a quick Q&A session. Again, because of high income inequality, a large unbanked sector, and low levels of financial literacy, many people are excluded from financial services that they need to sustain a healthy living for themselves and their loved ones. To respond to this large trend, the government and the private sector have been investing very much in microfinance. Yet, nonetheless, it is strongly disputed whether or not microfinance is the way to go. However, looming in the background is also a prevalent shadow banking industry where many institutions have taken it into their own hands to provide financial services to individuals outside of government regulation. And as to whether or not shadow banking then is better than microfinance or a comparable alternative, it's yet to be concluded, as there's still much more to learn about the shadow banking industry and the microfinance industry in many years to come. So yeah, I hope you guys enjoyed this very quick lecture about finance or finance in the Philippines. With that being said, I think I'm ready to take questions if people have them. I actually can't see if people are commenting or sending questions. JM, Jillian, do you think any of you can lend me a hand there?
Sure. We'll check the comment section out. Okay, we've received a question, and
Sure
the
thing.
person is asking a couple of things. So first question is, do you have any tips for defending corporations in debates? Because it seems intuitively hard to defend monopolies and big corporations amassing a lot of wealth.
Okay. Can you is that you mentioned that they had more questions? Can you also ask the rest of them?
Oh, it's a bit different. So do you have resources you would recommend for understanding finance, especially like derivatives and the stock market?
Okay, so I'll answer the second one. It's a bit easier for me to answer that. Investopedia works really well. There's a YouTube channel actually that's really good. I'm gonna look for its name. right now. Just give me one moment. I apologize. This is taking a while. Okay, I found it. Crash Course Economics is actually a very good YouTube source that I would recommend. And for the definitions and the fundamentals, Investopedia is a really good source I would recommend. I know other sources, but they're paid sources, so like they are protected by paywalls. I won't be recommending those because those aren't accessible. But for free to access sources, those are the sources I would recommend. And I would elaborate further by saying you don't need to, in most finance debates at the very least, you don't need to comprehend the intricate nature of financial instruments. You don't need to comprehend the entire financial industry for that matter. What you just need to, when you see a complicated finance motion, my tip is to just try to understand what is the change and trade-off that is being made. So recently, right, there was a motion set, I think it was in Doxbridge, it was about whether or not China should increase the amount of foreign reserves, or like expand the amount of foreign reserves in terms of yuan that other countries have. And foreign reserves is actually very complicated. And anyone could really go on and on for maybe hours about the implications there would be if China, or if the yuan became the most adopted foreign reserve as opposed to the dollar, for example. But really, the most important thing to consider at that point is really what is the biggest trade-off here. And the biggest trade-off here is the amount of control then that China has over the yuan currency, and use that then as the fulcrum of your debate. Should China have a lot of control over its currency, or does China want to take the risk of letting other people, or of lessening that control if it means more people use the yuan? What's the synthesis of all of that? The synthesis is, don't feel overwhelmed by a finance motion. Sometimes it's really asking you very simple questions, and the teams that win are the teams that are able to identify those simple questions and answer them as clearly as possible. Because the observation I make, or that I've come to see a lot of times, is people think if there's this very complicated motion, then they provide this symmetrically complicated argument. So for example, there was a motion about blockchain, and then the arguments were like about how blockchain, for example, would like solve the, what do you call this, would like solve the financial crisis, right? Or like the blockchain would create a financial crisis, when really it's just simply about like data privacy and unregulated currencies. It's not like, it's highly unlikely that finance motions would ask debaters to talk about extremely complicated things. I actually, that was a bit of a rant. I'll try to make a TLDR of it to make it easier to understand. Finance motions seem complicated, correct? But most good finance motions only ask you to compare simple things. The teams that do best are the teams that are able to identify what these simple things are. How then do I assure myself that I am able to understand the simple things in these finance motions? You can build upon the fundamentals of finance. You can do so by reading through Investopedia, or by watching the videos in Crash Course Economics. There we go. That is the complete and organized answer to your question. Now, the first question: can we defend corporations? It seems highly abhorrent that they accumulate a lot of wealth. And the answer to your question is, it is hard to say exactly. So I wouldn't homogenize. I wouldn't say all corporations are evil, but there definitely are corporations that are evil. And it depends on the debate itself. So if it's just simply the accumulation of wealth, you can talk about how it's about being able to tax properly then. If a corporation is able to accumulate wealth but is taxed properly, and their services themselves are not begotten from exploitation, then these are corporations that we are perfectly fine with. But if, for example, these corporations prey on low living wages, don't allow their employees to unionize, or actively crack down on unions within their businesses, then these are corporations we would not want to support. The implication then being, it's very difficult to, and I personally, it's just my personal opinion, would not find it compelling if a team just went, corporations are evil, the end. It would be it would have to be, in the context of the debate, a team framing what the most likely response of a average corporation in this context. Would that average response be evil? Because not every, for example, not every corporation is Amazon, right? Like there are many corporations really, well, not many of the big ones, but there are corporations that are conglomerates that actually spend a lot of their capital trying to help people. And with that being said, it's difficult to homogenize them. So to more directly answer your question, how do you defend corporations? Well, to be fair, like if the motion was something as like rudimentary as this house believes that corporations have done more harm than good. You can talk about a number of different things. One, the accumulation of wealth leads to corporations providing many good services. And in instances where corporations do this ethically, it's actually very good for society. For example, well, they might not be an ethical company, but I'll just use them for an example. A lot of the services Google provides are incredibly useful for other businesses. A free Google Drive, a free search browser, a free Google Drive search browser, the cloud. Yeah, a lot of the service. Oh, Google Suite is also incredibly useful for many businesses. Gmail is incredibly useful for many businesses. You can talk about how if Google wasn't able to accumulate that much wealth, many of these services would not be free. And many people then would be deprived of having access to a free searching browser or deprived of the ability to freely send emails to each other. And so maybe Google does introduce financial inequality by accumulating wealth, but the impact that their services have onto the rest of society outweigh the harm of that financial inequality. That's one way of which you can defend corporations. That was a bit of an improvised argument, but I hope it was sufficient.
All right. Thank you so much. We still have a couple of questions. So first is from Jazel, and they're asking, assuming we don't know anything about finance, what are canned arguments that we can run?
I mean, it harkens back to the very first thing I said. There's finance itself covers so many topics. Because finance, what's the definition of finance? It's the study of how people use money. And then it's not, and then broadly, then it stops being just people. It becomes people, corporations, states, NGOs, international organizations. And then suddenly, a finance motion can be something as simple as this house would make an account, this house as a, what do you call this? Like this house as a member of the vulnerable sector would opt into the shadow banking community. That can be considered finance. Something as simple as this house would raise the minimum wage can be considered finance. But then at the same time, something like this house believes that the EU this house would no longer adopt the euro can also be considered finance. And there is no canned argument that can be used in all three of those motions. Because one is just talking about whether or not it's risky to participate in the unregulated financial industry. One is about monetary policy and how currency is used. So what then can I tell you? I can give you canned arguments for, well, not necessarily canned arguments. I don't believe in canned arguments, but I believe in canned values. Things that you must always consider or keep in mind throughout debates. And the first thing is what I've been talking a lot about in this round. It's having access to financial services. In a finance debate that is in the domestic context, it's always important to consider that many people don't have access to good quality financial services and that this deprives them of opportunities and security. So in a canned debate, it's not really canned argument, it's a canned issue. So right from the very get-go, if you had no idea what the motion was about, like it was this house would insert jargon here, and that's really how you understand it, is this house would insert jargon here. Your canned standard can be, we will explain why this jargon here improves financial inclusion for the vulnerable sectors of society. That can be a canned standard you can use. In addition to financial inclusion, or to be fair, you can break down financial inclusion to the three things I mentioned earlier. You can be, we will explain how insert jargon here decreases the unbanked sector in the Philippines, increases financial literacy, but also provides opportunities that would have otherwise been withheld from vulnerable sectors. And then there you go. If you really need to wing it, you already have 3 standards that you can use for 3 arguments. Good luck winging it, though. So yeah, that's to recap my answer for people, if ever there are people just tuning in. If you really know nothing, admittedly that is a tough position to find yourself in, but fret not, there are still things you can do. The question initially asked for canned arguments. I don't think canned arguments work in the context of finance debates. So instead, I have provided for you canned standards. Those standards being the very large unbanked sector in the Philippines, the levels of financial literacy that people have, and the amount of opportunities that they can insert financial instruments that they can use at any given point in time. I hope that answers your question.
Okay, thank you. Next question is, hold on. Okay. How do you prove that banks have incentives to be good actors? It's often a bit hard when debaters frame them as greedy post 2008 financial crisis. And while I can kind of think that CSR or something works to make them more benevolent, I'm not sure enough of the mechanisms for how they work to unpack it.
Okay, so the answer to your question is you can't really prove that banks will be benevolent for the same reasons why you can't prove that what do you call this, corporations will be benevolent. Instead, what you can prove is that they are, so unless there is a sudden movement for benevolent banks, which we see in corporations, right? There's a sudden movement to be benevolent because of sustainability and the CSR goals that have been heavily promoted by the UN. You can prove that banks have an incentive to provide you good services. So I'll harken back to something mentioned earlier, competition. Banks are still private banks, and banks are still corporations in a sense. And that means they still need to make money. It also means that they are competing with other banks. What's the implication of this? If, let's say, Union Bank decides to drop the ball on all their services, offer the absolute worst interest rates imaginable, then everyone who has a Union Bank account will just cancel their account. Perhaps they'll move to BDO. I'm not saying that's what's happening right now, but that's an example. So that's one way you can mitigate the harm of banks being evil. There are self-correcting mechanisms that are in place right now. The first being competition. Banks still need to compete with each other because there are a lot of banks. There's BDO, there's Union Bank, there's BPI, there's Citibank, there's Robinsons Bank, there's Metro Bank. There's so much more that I haven't even named yet. There's Maybank. The point being, banks can't just all decide to give you the absolute worst services. They have an incentive to compete with each other, and this competition means that they won't be evil in the vast majority of instances. The second thing is government is improving its regulation. So the 2008 financial crisis, banks were able to capitalize on a loophole in the services in a loophole in financial regulations, because financial regulations did not cover yet derivative security. And so they were able to use derivative security to profit. And yes, they're evil for doing so, but this has been rectified in its entirety. It's now illegal to do the very things they were doing in the not the Asian financial crisis, but in the housing crisis in the US. And that's because the government has an interest to make these banks not entirely screw up the economy. So that's the second self-correcting mechanism. What then is the implication here? Is it true that banks are constantly, are still constantly trying to find ways to find loopholes in the system? The answer is yes. But in a world where the government is able to outpace these banks' capacities to subvert the system, it's highly unlikely that anything like the financial crisis of the past will happen again, save a world-ending pandemic like the one we encountered, or the one that we are currently encountering. Just to recap then, the question was, how do we defend banks or prove that banks won't be malicious actors, especially considering a lot of the empirical evidence that have shown that they often choose to be malicious instead of benevolent. I've presented two structural reasons that you can use to defend banks. First is competition. Competition is likely to self-correct harmful banks because otherwise these banks will lose all their clients who will choose to opt into benevolent banks instead. If competition doesn't work, government regulation can also work, and it has proven to work as we no longer see the kinds of trades that led to the housing crisis of the US in the past. I hope this answers your question.
All right, next question. Given its volatility, do you have tips in handling debates about cryptocurrency?
Okay. So the thing is, there aren't that many debates about cryptocurrency outside of this house would ban cryptocurrency. And even at that point, it seems like banning cryptocurrency is unlikely to work because you can look for it online. I have a lecture on blockchain because what I'm about to say is now like the 5-minute condensed version of that lecture. Cryptocurrency is one application of a particular kind of technology called blockchain technology. Without going into too much detail on it, blockchain technology is when instead of an encrypted network, it's entirely peer-to-peer. And because it's entirely peer-to-peer, how do I describe it? Because it's entirely peer-to-peer, it's both entirely transparent and entirely anonymous simultaneously. If you want to learn how that's possible, I highly encourage reading about blockchain. What's the implication of this? Cryptocurrency is incredibly volatile because blockchain is still an emerging technology and people are still trying to understand how to use it. That's why Bitcoin, the very first iteration of cryptocurrency, that was a result of blockchain, was incredibly volatile. It was unregulated. People were high on the emerging technology because people were branding it as the new internet. Like that's how big it was. People thought it's going to be the next internet. Remember in 1995 when people were like, the internet's going to be nothing, but then the internet turned out to be the biggest thing ever. Now it's the Bitcoin is going to be the next internet. That's how people were framing Bitcoin, and ultimately that's actually why it was very volatile. I think people underestimate the fact that blockchain isn't volatile because there's something wrong with blockchain. Blockchain is volatile because people don't know how to value blockchain. Because that's actually it. Like the secret behind blockchain is that its money is determined by people. People look at these cryptocurrencies and they tell themselves, how much do you think this is worth? And when they say, I'm willing to sell this cryptocurrency for this amount, and people are like, I'm willing to buy this cryptocurrency for this amount, algorithms aggregate the hundreds of thousands of people that are inputting these numbers to come up with the price for these cryptocurrencies. And because people don't understand cryptocurrency so much, their opinions on cryptocurrency change drastically and frequently all the time, leading to its volatile price. So let's try to solve a common misconception here. What makes Bitcoin volatile? It isn't like the Bitcoin technology itself is like, wow, I'm a wave. No, it's because people themselves don't know how they can value Bitcoin. The Bitcoin itself dropped so much because while people were high on it, it was discovered that things like child pornography, human trafficking, and drugs were being transacted using Bitcoin as the currency. And so governments started banning the use of Bitcoin so they could crack down on these human traffickers. And that's why the Bitcoin suddenly dropped very much. And then people weren't able to fully comprehend why that was the case. And so people have since then had a very drastic, volatile opinion on how to value cryptocurrencies. And that applies to cryptocurrencies now. Note that I kind of lost track. So I lost track a bit. I want to harken back to the original question. Can you give tips on cryptocurrency debates? The synthesis of this mini rant I've just given you is cryptocurrency is one application of blockchain, which means there's cryptocurrency itself is likely to still change many times moving forward because it's an emerging technology with emerging users, and the technology itself is still experimental in a sense. Its volatility isn't a product of there being an intrinsic problem with the technology itself, but because people don't know how to value the technology. People don't know if it's going to be very valuable or if it's going to be worthless. Well, it's not necessarily worthless, but worth much less than what people value it. And so the market itself is very volatile because the market is still adjusting to what exactly Bitcoin or cryptocurrencies should be valued as. With that being said, what then are some intrinsic qualities of cryptocurrency that you can keep in mind? And this is the important part here is that we're moving away from the volatility discussion because the volatility discussion actually has very little to do with the cryptocurrency itself. The cryptocurrency itself typically has the following characteristics. One, its transactions are anonymous. If I purchased from you, I know, like for example, maybe I know the exact user ID of the person I'm purchasing from, but most cryptocurrencies don't actually let you, like don't actually tell you who you're purchasing from. So that's the one of the first qualities of cryptocurrency. The second thing to know about cryptocurrency is that using the cryptocurrency itself to make transactions is very different than the trading of cryptocurrency. So right now, and this will be another mini rant. Cryptocurrencies are used in two different ways. One is people actually use the currency itself. So like people, like for the sake of an example, some people are actually using Bitcoin to make transactions. So I will buy one bottle of water for 1 Bitcoin. 1 Bitcoin is worth so much, by the way. That's not a good example of how much Bitcoins are worth. But yeah, there's some people who use Bitcoin for that reason. They actually trade the Bitcoin itself for goods and services. The other primary use of Bitcoin is that people use it like stock. Like people trade Bitcoin the same way people invest in Forex. So like, you know, there are some people who will buy the US dollar. They think the US dollar will increase in value more than the peso in like the next 10 years. So they invest in a lot of dollar with the intention of converting it into peso 10 years from now. And then that's how they make money. Some people do that with Bitcoin. So they buy Bitcoin and other cryptocurrencies, not for the purposes of using this cryptocurrency and blockchain technology, but because they want to trade it for more money in the future. They think, well, right now Bitcoin's 1,000 pesos. In 2 years, maybe it'll be 10,000. Who knows? So they buy it not for the purpose of using it, but because they want to sell it in the future. With that being said, what are things to consider? Honestly, it's been a while since the cryptocurrency debate was introduced. And I think the exact wording of like this house would ban cryptocurrency, this house would ban Bitcoin has been overdone. And it's highly unlikely you'll ever see a motion like that again. But in motions where cryptocurrency is the focus, remember these things. I'll just be summarizing now some of the things I've talked about. One, its volatility doesn't come from a problem in the technology. Its volatility comes from society and the government simultaneously being unable to understand how much you can value cryptocurrency. But secondly, that cryptocurrency is hardly used for its actual intended purpose of making transactions in blockchain technology. It's because of society, its primary use is to trade it like stocks. I'm not confident that I answered the question, but I hope at the very least this discussion was useful.
Right, thank you. We're on to our last two questions, I think. So this one's more for, I guess they're asking for advice for people who set motions. How do you usually stress test finance motions, especially given that it's often quite niche or academic? Like, how do you usually make sure finance motions are balanced for CAs?
Okay, good question. I'll be writing what I normally do is after I write down a finance motion, writing down the stress test helps me. So I'll be simultaneously doing that to answer your question. So the first thing I'm gonna do is do the usual checks. So you check if government and opposition have an equal probability of winning, if the arguments are both accessible and debatable. That is to say, there is no intrinsically winning issue on either side. Some debates have some issues that are doomed to be won in one side. So for example, if there is a debate where government had to defend access, opposition had to defend quality, some debates are designed to be that way, where it's really designed such that government bench will win access or an opposition bench will win quality. And it's really and what the Adjudicator want to test is, can government frame why access is better than quality, or can opposition frame why quality is better than access? So that's an example. Let me further elaborate on the standard. So you ask yourself, are there intrinsically more important issues in either bench? The answer has to be no, because for example, if government's benefit is the rich get richer and opposition's bench is we solve poverty, then obviously there's no way on earth government's going to win that debate. The first question you ask yourself is, are the issues that are won on both sides fair and debatable? After you ask that question, so after you resolve gov op, you resolve opening closing, you ask yourself, if there are in the motions that government can run, if government runs any combination of three of them, is it still possible for closing to win? I realize that I'm PIDC advocate, but I'm giving BP advice. I should have clarified that. I'll be giving advice for BP motions, but I'll also give advice for Asians motions later. For now, we're using BP. Yeah, so opening, closing. You want to make sure that the arguments from opening and closing are, it's impossible for opening to take all the arguments. Not just in number, but all the relevant arguments. So if government had four arguments, one is solve poverty, two is solve world hunger, three is cure cancer, and four is the rich get richer. If government can run the first three and then closing is up with the fourth, then you don't want to set that because OG will just totally defeat closing. So you want to make sure that in addition to it being balanced between government and opposition, it's balanced between opening and closing. The next thing you can ask yourself is if particular arguments are harder to buy than others. So it's entirely possible that the member of the Adjudication Core who is setting a motion is setting a motion from their personal background, which is actually a common phenomenon. If you're someone who is from a tech background, you're likelier to set tech motions because you're more familiar with the industry. If you're someone who is familiar with law, you're likely to know or set more law motions than someone who has no idea what the laws are. And with that being said, it's also entirely possible that the person who sets a motion thinks that a motion is balanced only because arguments that aren't accessible to other people are accessible to them. So, for example, let's say there was a motion about blockchain and the government bench defending that motion has very accessible arguments. In opposition, if the arguments are inaccessible but are still balanced, it's worth deprioritizing this motion because you don't want the intellectual lottery to be the reason why a team wins over the other. You don't want the reason why a team beats another team is they just so happen to read about this article that's not even relevant today. And for that reason, they are given the reward of winning the round, as opposed to someone who may have diligently prepared for a tournament, but because they didn't so happen to read about a particular article, are then unable to win altogether. So before I move into the fourth thing, I'll just recap the three. Gov versus op, is it fair? Are there any unbalanced issues between gov and op? And then opening versus closing, is it possible for the opening half to just totally hijack all the good arguments? After that, then there's also the accessibility. Is a bench gonna have to rely on technical knowledge to have a stand in the debate? If they do, then it's problematic. I remember I had a fourth standard. I'm just trying to remember what it was. Give me one moment. No, I'm opening my documents. I'm pretty sure I have it here. Oh, the last thing. There's two more things I would do to stress test. So I already shared three. The fourth is, are there silver bullets? So this is one of those silver bullets can take form in many different ways. Silver bullets can be one side really just has this one argument that totally, even if they run nothing else, just wins the debate. You don't want a silver bullet argument. But in addition to silver bullet arguments, there are things like silver bullet framing or silver bullet definitions. So it's like if a particular bench takes or has the freedom to take a particularly harmful stance or unwinnable stance, unbeatable stance, you don't want that kind of motion taking place. So it's one of those motions, it's like you don't want a motion where one side is like this house would do X. And then let's say government benches to defend X, but then opposition suddenly has to fit to go, instead of doing X, we'll cure cancer. You don't want to have that kind of silver bullet framing where a team has the freedom to suddenly introduce the perfect alternative, as opposed to one bench that has to defend a forced comparative because of the motion. So that's the fourth thing I would consider. The last thing I would consider is if there's a false dichotomy. So one of the most common things I've encountered, actually, and I've only realized this now, and I've scored with a lot of people, and most finance motions that don't make it to the final sets are motions that introduce false dichotomies. So it will be like, this house would do X over Y, and then whenever I see, like, if I'm in the adjudication core, if I'm in a team of adjudication core and I see a motion that reads, this house would do X over Y, I ask myself, do we have to do X over Y, or do we have to do Y over X? Can we not do both? Is there a Z that's better than both of these things? If any of those four questions is yes, you don't want the motion to be done anymore, because it's, well, one, if you can do X over Y, that it's, no, sorry, like, if Y can be done simultaneously with X and X can be done simultaneously with Y, technically speaking, you're having the debaters waste their time debating this motion. Because this isn't just a personal preference of mine. I don't just want debaters to debate motions that are debatable. I want debaters to debate motions that go somewhere. Like, I don't want people to walk out of the debate going, well, this was a colossal waste of time because this isn't going to apply in real life anyway. I want people to debate motions that have implications, that make people think about, what if this really was something that happened? So it, like, value judgment motions, right? Like, what if people really felt this way about something? Policy motions that actually do have impacts on society, or that could actually take place. Like, this house believes that a One Belt One Road initiative, or like this house as China would stop the One Belt One Road initiative, for example, right? Like, that could actually happen. That is a choice that China has. But if it's like two things that can be co-opted simultaneously, it just means that we will never encounter a world where the motion actually takes place. In fact, we will never even encounter a world where the motion is relevant. And so I would not want a debate done of that caliber. I will recap the 5 things I've said and then answer the last question. Recap. Question: how do we stress test finance motions? I normally ask for 5 things. I look for 5 things. First, is it balanced between gov and up? Is it balanced between opening and closing? Is the information for these balanced arguments accessible? Are there silver bullets that can be used? And is this relevant? Is this a false dichotomy, or is this actually something that has implications in real life? Those are the 5 things I try to look for. In many motions, not just finance motions, but in many different motions. Those are the 5 things I look for. I hope I answered your question. I can answer one more question because I also have to go at like 9:30.
Okay, yeah, just one last question. Also, to answer your question about whether or not, the person who asked about cryptocurrency had their question answered. The question is from Bea Legaspi, and she's really happy and found the answer very useful.
Thank you so much.
Last question. Do you have any tips in characterizing SMEs in debates?
It depends on the debate. So SMEs, these are small businesses, small to medium enterprises. I guess I can just give you frames that I would use generally, or things that I always keep in mind with SMEs. Good question. I actually didn't put too much thought into this. I'll try to relate it to at least the financial industry, but I'm not sure if I can give you a comprehensive answer. In terms of the financial industry, SMEs are also excluded from many traditional banks. For the reasons I mentioned earlier, SMEs are also seen as risky businesses because they don't cater to a large market, or are impacted more by economic disruptions like the pandemic. And so banks don't want to loan money or give lucrative deals to these banks. And so I guess in terms of the financial industry, you can look at an SME similarly to a vulnerable sector. There are many financial instruments that are deprived from them, not because of their actual proficiency, but because of their status as an SME. Additionally, I would say things like, I really like. It's a very admittedly it really depends on the debate and the context. Like SMEs will vary depending on the industry. Okay, here's how I'll answer the question instead. I can't answer the question exactly. So instead, I'll give you things to keep in mind before you frame the SME of the debate. Because I presume you're trying to foresee motions about SMEs in the future. To which I say, that's good. But keep in mind that more often than not, debates about SMEs vary for vary in different ways. These are the ways that they vary. First, the industry in which they're in. SMEs have different structural incentives or incentive structures depending on their industry. So it could be you're an SME in the agricultural industry, you're an SME in the e-commerce industry, you're an SME in the real estate industry. Depending on the industry of which this SME is focused, your interests could change. So when you're framing an SME in a debate, always keep in mind first the industry of which it is in. The second thing you'd want to keep in mind is the country in which it is in. So this is, I think it's a bit more straightforward. If you're an SME and your service is something that a country specializes in, one could frame that to be a disadvantage. For example, if you're an agricultural SME, it's very difficult then to compete with MNCs that are agricultural in nature in the country of your origin. So you are particularly vulnerable for that reason. On the other hand, if you're an SME in an industry that is still in its birthing stage, that actually could be an advantage. For example, Grab was an SME at one point, right? But it was an SME in the taxi cab industry, and because the taxi cab industry had not yet reached its maturity stage, it was just still the usual taxi cabs up until a few years ago. What was once the SME, that is Grab, suddenly became the large MNC that we know today. Same thing for Airbnb. The implication of this being, not only should you consider the industry of which the SME is in, but also the context of the country in which it is in. If you're an SME and you're in a matured industry because of the country of your origin, you are particularly vulnerable because you have to compete with very large businesses that already have saturated the market. If you're an SME in an industry that is emerging in the country of which you are in, that is actually a big opportunity, and the SME may not be as vulnerable as other SMEs for that reason. I hope that answers your question enough. These aren't exact frames to use for SMEs, but these are definitely things to consider. So if there was a debate like this house as an SME from this industry in this context would do Y, and I was the prime minister, I'd always go, before I proceed, I want to talk about two things. Firstly, the industry of this SME, and secondly, the country of this SME. Then I talk about industry, its implications on the motion, the country and its implications on the motion. Yeah, that's it from me. I actually really, really enjoyed the question. So to everyone who is listening and watching, thank you all so much. I really hope my gratitude comes across because I really am grateful. Admittedly, I was quite nervous for this lecture, but hearing all these questions that were very intriguing definitely made me happy. Definitely, I really appreciate it. Made me feel like I was listened to, and for that I can't all the thanks in the world. All the thanks as well to the organizers for having invited me to give this lecture. And yeah, that's it from me. I guess I pass the floor on to anyone from the OC who wants to say something.
All right, I think those are all the questions. Thank you, Nicolas, for sharing your expertise on finance with us tonight. We're sure you've been a huge help to debaters in the Philippines and everywhere. So we'd like to thank also everyone who joined tonight, second lecture of PIDC lecture series. We still have 3 lectures coming up: case preparation, adjudication, and international relations. So see you guys there. Again, thank you so much, Nico, and let's all have a good night.